Introduction. Capital structure refers to the mixture of debt and equity that a firm uses to finance its operations and growth. The decision regarding the optimal capital structure is critical because it influences the company's risk profile, cost of capital, and overall value. This module explores theories and practical considerations related to capital structure, leverage effects, and the trade-offs involved. Understanding capital structure. The capital structure is typically composed of equity, common stock, retained earnings, and sometimes preferred stock. Debt, long-term loans, bonds, and other interest-bearing liabilities. The mix of these sources affects the firm's financial flexibility and risk. Theories of capital structure. Trade-off theory. This theory suggests firms balance the tax benefits of debt, interest tax shield, against bankruptcy and financial distress costs. Benefit: interest payments are tax-deductible. Cost: high debt increases bankruptcy risk and agency costs. The optimal capital structure maximizes firm value by balancing these factors. Pecking order theory. This theory proposes firms prefer internal financing first, then debt, and issue equity as a last resort. Reasons include avoiding information asymmetry, minimizing issuance costs, maintaining control. Signaling theory. Firms signal their quality to the market through capital structure choices. Issuing debt may signal confidence. Issuing equity might signal overvaluation or financial distress. Leverage. Operating and financial. Operating leverage relates to the firm's fixed versus variable costs in operations. High fixed costs equals high operating leverage. Amplifies the effect of sales changes on operating income. Financial leverage relates to the use of debt financing. Debt amplifies returns to equity holders, but increases financial risk. Measured by ratios like debt to equity and degree of financial leverage. Effects of leverage. Positive leverage. Effect: when return on assets exceeds cost of debt, leverage increases shareholder returns. Negative leverage effect: when cost of debt exceeds returns, leverage reduces shareholder returns. Increased leverage increases the risk of financial distress and bankruptcy. Bankruptcy and agency costs. Bankruptcy costs: direct legal fees and indirect lost customers, suppliers. Agency costs: conflicts between shareholders and debt holders or managers. These costs influence firms to limit debt levels. Factors influencing capital structure decisions: business risk, tax position, market conditions, growth opportunities, asset structure, management preferences. Optimal capital structure. The optimal capital structure is where the firm's weighted average cost of capital, WACC, is minimized and firm value is maximized. Summary. This module highlights the complexity of capital structure decisions, the importance of balancing debt and equity, and the trade-offs involving tax benefits, financial risk, and agency problems. Understanding leverage helps firms optimize financing and enhance shareholder value.